Okay, welcome. This is Kurt Frankenberg, the founder of RadioActive Trading and author of the Blueprints.
Mm-hmm.
And I'm joined by my good buddy Mike Chepka. How's it going there, Mike?
Well, things are going okay today, Kurt. Still looking at some new positions after we went through the May expiration, the standard May expiration, I should say. So still looking across the universe there to find some maybe new positions to open with some capital left over from closed positions, as I believe you are as well.
Right, yes, Expiration Friday was good to me. So, well, good. This is our first presentation after Expiration Friday, and I thought yesterday that I would look back over some posts that I had done in the RadioActive Trading blog, and I saw something that I thought I would share with
Okay.
folks, and today we're going to be looking at a brand new presentation, okay. And I wanted folks to really understand what we're about here, okay? Mike, RadioActive Trading, the mission from day one has been to help folks that had gotten hurt with
Mm-hmm.
incomplete options trading information, okay? That was my mission from day one. In fact, I began, before writing the blueprint, I began just by blogging and giving away, you know, for free what it was that I was up to, what I was doing. Okay,
Mm-hmm.
so before we go into our presentation, I wanted to let everybody know, hey, look, relax. We're not here to sell you anything. It's not going to be one of those, hey, amazing, totally cool, and you've got to get started right now, or you're going to miss out, you're going to lose. Okay, what I wanted to do there, folks, is to share just some things that I've been learning over the last 10 years about options trading and how options can be used to improve your portfolio. Okay? All right, so 100% content today. We're going to take a common problem for traders, okay,
Mm-hmm.
and we're going to fix it. We're going to take that common problem and we're going to fix it. And I might point you out to some further free resources. Oh, look, my Southern heritage is showing. I didn't say further, I said further.
Oh, I see.
Yeah, I'm going to point you out to further free resources, and that's pretty much the extent of what we're doing today. But I think you're going to really appreciate it, folks. Okay, that's what to expect. Okay, so now I'm going to ask folks to introduce themselves. Okay, what kind of options plays are you doing now? And let me put up the poll here. Okay, we just want to know what options plays you're doing now, and check all that apply. For example, if you're doing cover calls and you're also doing spread trades, let us know both. If you're just doing long calls and puts for leverage, or if you don't trade options, that's fine. Let us know. Mike, we've even seen people say something like, "I trade cover calls" or "I trade naked calls and options me no likey," right?
Well, of course, yeah, we can have that experience, that's for sure.
Okay. Nobody so far has checked that, by the way. No one has checked options me no likey. So I think we've got a pretty savvy audience, and we do still have some votes rolling in. So let me give it another few seconds here. A lot of folks doing cover calls. A lot of folks. That's interesting. Okay, let me go ahead and close that poll and share results. Mike, we've got 10 of our online attendees doing cover calls and naked puts,
Mm-hmm.
and that's interesting because I thought today's promise, today's presentation was going to draw more spread traders, and although that is second place, I didn't think that we'd have more cover callers. Nobody has said options me no likey, so it looks like we've got a pretty savvy audience. Okay, and even some intrepid souls that do naked calls. So how about that? Okay, go ahead and hide that, and we're going to ask this. Okay, one more follow-up poll. Okay, looking back, are you happy with your trading results? And rather than just a strict, straight-up yes or no, I'm leaving a spectrum of answers there. Spectrum of answers. So it could be yes, I'm super, super happy, or it could be man, I am super unhappy,
Mm-hmm.
or anything in between. And the way that we usually see this play out is with that familiar 80-20 rule, where 20% fill in the first two lines and 80% fill in the last three lines. Right now, we're seeing it kind of shy here. I've got about 13% in the first two lines. Oh, and the number's even going down as people are continuing to come in and cast their vote. Well, that's disheartening. Wow. Mike, I'm going to close this poll here in 5 seconds. That'll be the full minute. And 3, 2, 1. Wow. Get a single-digit amount. Single-digit amount. Nobody said yes in 12 months. I've done very, very well. 9% said I'm happy with my trading, but I could stand to be happier. So that leaves the remaining 91% with either mixed emotions or just plain unhappy or ready to quit. So, wow. Mike, later on we're going to do a little before after and see if folks are happier knowing this situation that I'm going to share.
Okay.
So let me go ahead and talk about what we're going to talk about, okay? And then we'll dive in. In the seminar, I'm going to make 3 bold promises, okay? The first one, I'm going to show you the solution, okay, or a real good solution to a big problem that faces buy and holders today. And I'm willing to bet that you're going to take a look back and wish that you had thought of it sooner, okay? And this is something that has come out of the development of radioactive trading over the last 10 years. Number 2, I'm going to show you a riskless spread trade. And gosh, we had over 60%. I think it was 60. Was it 63, 68%?
68%, yeah.
Well, a lot of folks are doing spread trades, and I would like to show you a riskless spread trade, one that's done at a credit. And I know that sounds like a big, bold claim, and it is, all right? But normally a credit spread involves risk, but I said it would be riskless, and it is in the context in which I show it, okay? If you do it any other way, it won't be riskless, okay? But in the context that I'm going to show, it's pretty impressive, okay? All right, and then finally, I'm going to show you how it's possible to actually take income from your stock without necessarily selling it, or get this, we've got a lot of covered callers on the line, right? We're going to talk about how to take some income from your stock without limiting the upside. Without limiting the upside, and that is a tall order. So, with that said, let's go ahead and jump in. I'm going to be showing out what knowing these 2 techniques means in dollars and cents, just as one trade, and I'm going to give you these strategies with no charge and no other reason than for you to think I'm pretty cool. All right, so we're going to solve a big problem once and for all. We're going to show a riskless spread trade, one of several, that captures premium, and we're going to take a credit without limiting our upside. Are we ready to go?
I think we're ready to go.
Let's rock it. Okay. Now, we already did this baseline result. Here's the problem, okay? The problem that I'm going to pose here, and this may not seem like a problem to some, but it is, okay? What if my stock is up from where I bought it? What if my stock is up from where I bought it? Now, that's a good problem to have. All right.
But it comes with a problem.
Yeah, it comes with a lot of considerations, okay? For example, now what? I don't want to feel like a chump, okay? I don't want to, A, sell my stock, okay? I want you to read this carefully, folks. If I sell my stock and it keeps going higher, I will miss the boat. Anybody ever feel that way?
Well, it's one of the problems that we have. We've matched our goals. Maybe when we closed the stock, we thought it hit the 52-week high, and lo and behold, 3 weeks later, it's gone through 7 new 52-week highs.
Right. Okay. And by the way, folks, this sentiment I have expressed in the form of a haiku. If I sell my stock and it keeps going higher, I will miss the boat. Okay. Well, what about this? But if I hold it, I might give back my profits. The stock goes down the drain. There's nothing worse than getting to, I can speak from personal experience to this, Mike, because before I learned about trading options, and before I learned the principles that I write about on the RadioActive Trading blog for free, and of course that I've got in the book too. Before I learned this, Mike, I bought a stock one time at $8.50, and I felt like an absolute freaking genius when it went to $12.50.
Mm-hmm.
All right, and then when it went to $24 and change, I felt like a trading god. But then when it came down to 18, you know what? They say that a mind that's expanded by an idea never regains its original size.
Hmm.
Well, that's true. But an ego that gets inflated to a certain point, is even harder without the bubble getting burst. Here's the deal: when that stock went down to 18, I said, "Well, I can't sell it. I can't sell it because it was up past 24."
Right.
And then when it went down to $12, I said, "Well, I can't sell it now." I mean, I got it at 8.50, and I was really, really right. And then when it went down below 8.50, of course I couldn't sell it. Of course I couldn't sell it, because then I would be taking a loss, and I had seen that stock all the way up at 24 and change.
That's right.
Yeah. Do you want to know where I finally sold out of that stock before it hit the pink sheets?
Was it under $1?
Yeah. I ended up selling it for 26 cents a share.
Okay.
Not cool. Okay. All right. So a lot of times, folks, we look at where our stock is, and we get emotionally attached. We say, I'm not going to sell. I'm not going to sell because I've seen how high it can go, and that kind of thinking will eventually betray you. Okay.
Mm-hmm.
If I hold it, I might give back my profits. Stock goes down the drain. There's another haiku, by the way. Not trying to be funny. Well, yeah, I am trying to be funny. But here's the deal. Why hasn't this problem been solved yet? Okay. Well, the reason that the problem hasn't been solved is we've only looked at two ways of solving it. The only two choices that we've discussed so far are I'm going to hold my stock. It says buying. It should say hold. I'm going to hold my stock, or I'm going to sell my stock.
Mm-hmm.
And that's really the only options that we've discussed. Okay. But there is another option. Okay, another option. Now, everyone has heard this little chestnut, Mike, of cut your losers short, let your winners run, right?
Yeah, a lot like buy low, sell high, right, Kurt?
Yeah, it's one of those sayings that's sounds good on paper, so to speak.
Mm-hmm.
But when you go out in the real world and try to practice it, well, it's not near as clear cut. Okay, few give the practical instruction of how to accomplish cutting your losers short, letting your winners run. Okay? Now, I'm going to go ahead and take issue with the covered call crowd, okay? And I'm sorry about this, guys. I'm not trying to poke fun at you or be a jerk, but you did tell me, Mike, we had 91% say that they weren't happy with their trading. Am I right, or am I
That's
crazy?
right. That's based on our votes. That's what we had. 91% were unhappy with their trading results over the last 12 months.
Right. I'm throwing that up there. We've got 9% saying I'm happy, but could stand to be happier. The other 91% varying shades of not happy.
Mm-hmm.
And that's with how many doing cover calls? Let me go back here. Hang on. Options trader doing 7% are doing cover calls. Well, Mike, we're supposed to be making 3% to 6% per month with our cover calls. How come they're not happy?
Well, that's what's advertised because it sounds sexy. And renting out your stock, that sounds sexy. But going back to the slide there, when you just look at the profit and loss chart there for the standard covered call, we can immediately see a problem that long term, over the course of several years of trading, this doesn't look like a winning solution, does it?
No, and the reason is that, Mike, if we're right in our sentiment, okay, if we bought a stock, and you don't buy a stock unless you're bullish on the stock, right?
That's right.
So some folks will say that cover calls trading is a neutral strategy. No, a condor is a neutral strategy. Okay, cover call is, and this isn't my propaganda. This is up on the free sites. Okay, I just pulled this off of the education segment of Options Express,
Mm-hmm.
my broker. Okay, I just pulled this off of my broker's site here. It is a bullish expectation. You don't buy stock, and stock is the major portion of this hedge. Okay, you don't buy stock unless you think it's going to go up. But if you're right, if you end up being right about your sentiment, well, what you do is you guarantee somebody else the stock at their price. I don't think that makes any sense at all.
Mm-hmm.
And they say that it's safer, and I suppose it's safer than just straight up owning the stock, but by how much? I mean, just a few
percentage points. Yeah, I'm still risking 97% to 95% of what I invested into the position, aren't I?
Right. If you're picking up 3 to 5% in premium, you're risking 97, 95%.
Mm-hmm.
Okay. And so the reward is limited, but the upside is not open. Okay, so I think that this would I'd be fair in saying that this is the reverse of cut your losers short, let your winners run. Would you go along with that, Mike?
I agree, yes.
Yeah. Okay, and normally spread trades, pardon me, spread trades do have the feature of dialing in a loss limit, okay, at least vertical spreads do. Okay, but they normally fail when it comes to letting winners run. For example, Mike, let's say that I'm selling bear call spreads. I sell the $35 call, and I buy the $40 call, and I take credit. If the stock goes below 35, I make money, right?
Yes, both calls will expire worthless, and you keep that net credit that you had, Kurt.
Right. So if the stock goes to 34, I make money.
Mm-hmm.
If the stock goes to 20 on this bearish play, do I make more money?
Well, no, you still make your maximum profit of the credit you receive, but you can't make any more than that initial credit point.
Oh, okay. So I can't make more than I initially take in.
Mm-hmm.
So essentially it's locked in loss and a locked in profit, and that's it. So it could cut my losers short, you know, if I happen to be wrong in my expectation, but does it let my winners run?
Nope.
No way. Okay. So years ago, folks, I got this idea, and we're going to talk about more than married puts here, okay? But I'm going to talk about the beginning structure of everything that I do. All right, I got this weird idea that maybe limiting the downside while leaving the upside open was a better way to go.
Mm-hmm.
And I don't think that's crazy. Here again, we've got a bullish outlook. Here again, it says that it's safer, and I agree that it's safer. But now we have an unlimited upside. Now, about this time, Mike, we have a lot of folks start texting in, and they say, are all your strategies bullish? Well, no. But, I mean, it's certainly possible to do this sort of setup. We got 3 different ways to do a married put or married put-like setup that has a bearish expectation.
Mm-hmm.
But since I'm just going to expose this idea for the first time to a lot of folks, I'm going to stick with the bullish idea, all right, and we'll go forward from there. But Mike, could, for example, could somebody do a protective put or a married put trade on an inverse ETF? Would that be one way to approach this from a bearish standpoint?
Absolutely. I think I actually have one of those right now.
Yeah. Okay, you do?
I believe I do, yeah. Mm-hmm.
Yeah. Okay. So so we're going to go into this, but remember we started with the conundrum of a person that's got a stock and it's up from where they started. Okay. So we're going to structure a bulletproof radioactive profit machine. The radioactive profit machine is what I call a married put that's fashioned according to some very specific parameters. One of those parameters is that you buy a put option that's you know, out in time a bit, and another parameter is that it's in the money, and another parameter is that if you're going to sell premium, you do that in the near term. Okay,
Mm-hmm.
we're just going to take a look at this. Now we had a subscriber write in named Ravi that had shares of RCI at a cost basis of an average of $27.50. Okay, he had gotten them over a period of time I believe he works for RCI. I'm not sure. But he had gotten them over a period of time at various cost bases, and so this was kind of the average. All right, 2750. On March 26th, I wrote a blog post using that day's put prices. Okay, so on March 26th, these shares are trading at $38.95. Now, Ravi's got a conundrum. All right, he could buy. He could sell, and if he sells, he has got $11.45 in pocket. Of course, that might come along with a tax problem, right? I mean, thank you, George Sr., but we've got this capital gains tax problem going on, and he may just not want to sell the stock right now. But he has an $11.45 gain to protect today. Okay, this is his conundrum. He doesn't know if it's going to go any higher or if it's going to go any lower. All right, so on March 26th, we're looking at his cost basis for the RCI shares of $27.50. But remember, pardon me, I keep clearing my throat. I've got something stuck. Can you hold on just a second there, Mike? I'm going to take a sip of tea here.
Oh, okay, sure, go ahead. So what the RCI position was, remember, we've got the cost per share for the customer is $27.50, and with the stock now trading at 38, Kurt looked out to a July option. So we're in March, and we're looking July, so it's about 4 months out of time. It's about 150 days out of time at this point. But the 40 put is priced at $2.90. So if we add that all together, the new cost basis on the position is $30.40. So we're adding $2.90 to the underlying cost basis, but we're guaranteed to get $40 back. So there's a locked-in profit. No matter what happens, the customer is now guaranteed to get $9.60 of profit. But the upside is not capped. We haven't sold a call. We haven't done any position that would limit the upside gain. So there's still room for further upside growth on the position. And the worst case scenario, if the stock pulls back or if it ends up trading below $40 and no other adjustments are made, you're still guaranteed a profit of $960 or 31.6%.
That's right. So, so now, Mike, right after this is executed, pardon me, right after we buy this put option for $2.90, have we lost $2.90? Is it gone?
No. No, as soon as I open the position, I can turn around and sell that put for maybe $2.80 or maybe $2.85. All that we've risked so far by buying that put technically is the bid-ask spread on the position.
Right. Okay, so by picking that spread up, or not that spread, but picking that that put up, we've got two assets now. One asset is the stock. The other asset is the put option. And if the stock goes down, we're going to be glad that we picked up the put. Yes?
That's right.
But if the stock goes up, we can still continue to gain. Now, what's at risk there is the $2.90. And remember, I had claimed that we're going to get paid to do this. Wait a minute, you might be saying. Didn't you say you weren't going to spend anything? Okay, and right there, I just showed myself spending $2.90 on a put option. Okay, all right, so fair enough. What we're going to do is we're going to figure out a way to finance the cost of that $2.90 put option. Well, what's one way we could do that, Mike? Where's most people's head go?
Well, we want to, let's generate some premium. We've got a stock, and we've got a put protecting it, so let's sell a call against it. That seems simple enough, right?
Right, and that's what most folks think about, but then we're hitting that conundrum again, the conundrum of limiting our gains. Limiting our gains. We're essentially saying, wow, if the stock goes up, this is all I'm going to take, and I'm out. That's what happens with the covered call. So let's think of some other ideas. Okay, how about this, Mike? How about instead of selling a call straight up, you know, plain vanilla, we sell, this is March 26th, by the way, we sell an April $35 call for $3.60 and simultaneously buy an April $40 call for 30 cents. Now that makes for a credit of 330. Ooh. Okay. Now, does the 330 cancel my $2.90 expenditure on the put option?
Yes, it does. You're taking in 330. We paid 290 for the put, so now we've financed the put purchase that's out to July.
Okay. Now, just by itself, do you see a problem with doing a bear call spread?
Well, following our general axiom that we were talking about earlier, the first problem is, well, we do have a possible gain of 330, but we can't make any more than that if the stock collapses. But that's okay because we're still long on the stock. We're probably bullish as it is. But just by itself now, if we're expecting the stock to go up and the stock goes above 40, well, we're going to lose about $1.70 on the position.
Right. We're going to have to come in with $5. You know, we've got to deliver shares of stock at 35.
Mm-hmm.
After we deliver our shares of stock at 35, we've got to buy them, and we'll buy them if the stock is at 40 or higher. We're going to use that long call to buy the stock at 40,
mm-hmm.
so that we can deliver it for 35, and so that's a $5 loss. Since we've collected 330 to do this, it's a net loss
Mm-hmm.
of $1.70. Okay, and so that's added risk. That's $1.70 of risk. Now, here's the deal. Doesn't that put even more at risk? You know, here you are. First of all, you're risking your $2.90, right? And
Mm-hmm.
now you're risking another $1.70. What are you doing, Frankenberg? Okay, well, yeah, I understand that $3.30 credit comes with a little bit of a liability.
Mm-hmm.
But here's how all four legs look put together. Now, Mike, there's something missing from this graph. Before we talk about the graph, what is missing?
Well, there's no negative. There's no red. There's no loss.
Yeah, there's no red line. I mean, as far as if the stock goes up, down, or sideways, we've locked in some money. And in
Mm-hmm.
fact, when we had just bought the put option at what was it? At $2.90.
$2.90, yes.
Yeah, we had locked in $9.60. But here, even by taking on an obligation where we may have to end up delivering stock and our profit line goes down, all
Mm-hmm.
right. Even if that happens, now we're looking at $9.72. Interesting. We've actually kind of picked up a little bit of profit. If the stock goes down, we're going to still be ahead of the game. And the reason that we're ahead of the game, Mike, is that we have the stock on hand to deliver at a lower cost basis than that $35.
Right.
Okay. All right. But let's talk about this dip. What's going on with this dip? I mean, we took in some income here, right? And now we're delivering the stock at 35. And so why are we taking a dip? What else is losing value here?
Well, as the stock goes above 35, you're no longer gaining one-to-one on the stock because you have the obligation to deliver that stock at 35, and your put value is declining as well.
Okay. So the put is headed down, and so that's what's going on here. Okay. But what about if the stock keeps going up higher? Why is this unlimited instead of being capped off like a covered call play?
Well, because now the long call is still gaining. Even if you end up having to deliver those shares of stock at 35, you still have a long call that you were essentially paid to own that is now gaining in value as the stock continues to move up in price.
That's right. I own the $40 calls at a credit.
Mm-hmm.
I've been paid to own them. That's kind of cool. Okay. Now, here's the deal. We're going to talk about management because I almost never talk about management in these free videos. Okay. A lot of times I say, well, that's what the book is for, right?
Mm-hmm.
But let's go ahead and give that away. Okay. A lot of folks don't get that you can often roll a bear call spread at a credit. You can buy to close it and then sell to open the next month out at a credit sometimes. Even if you can't do it at a credit, it can be advantageous to close a near-term bear call spread and open a far-term bear call spread, and that's because the stock has a tendency to, well, move. I mean, it can move up or down, right?
That's right.
So rolling the spread delays your payment if you come up liable, okay, if you come up needing to pay, okay. Meanwhile, the stock going up or down, in the context that I've shown, you still have a guaranteed gain. There's really nothing at risk in here because of the context of you already own stock. And there's nothing at risk in terms of the put because you used a bear call spread to pay for the put.
Mm-hmm.
Does that make sense? The worst case scenario is that our trader has a $9.72 gain. That's the worst case scenario. Okay? All right, so here's the deal. Here's what actually happened on Expiration Friday in April. They closed in the money. Oh, no. Here's what happened. The stock actually went to $39.66. Now, that means that you either allow yourself to be assigned at $35 and immediately buy your stock at $39.66 if you want to keep the stock, or you set a limit order to buy to close that call, and it's likely to be filled at lower than that 490. Okay, it's going to probably be filled at 480, 485, 470. You know, close to the close of the business. Okay, so now we're going to roll. If you look there at the bottom, Mike, we've got the bid price on the $35 calls in May. The bid price is $440.
Yes.
And the ask price on the $40 calls is 90 cents. Okay, so even if we don't get in the spread, even if we don't get a really good fill, okay, we get the worst fill possible, we're going to take another credit here of 350. Now I realize that 350 doesn't completely cover the 466, does it?
No, that's correct.
But remember, because I have that 466, or the reason that I have that 466 debit is because I took a 330 credit. So does the 330 credit plus the 350 credit cancel it?
That's right. Yeah, so that's up about $6.80 now, right?
Right. It'd be 330 for the April bear call spread and 350 for the May bear call spread. So that's 680, and I'm spending 466 to close this obligation in April. Okay, so that's the deal. Now, on Expiration Friday, oh dang it! You know what? This isn't May Expiration Friday, but I'll tell you where it ended up. Okay, sorry about that, guys. I didn't put the right graphic in there, but you can look this up historically. The closing price was $35.21. So again, that means I can allow myself to be assigned at $35 and buy the stock again at $35.21. Or I can place a limit order really close to the market and get filled for 21, 25, 30 cents. Okay, but by closing that second bear call spread, I'm not going to have to deliver anything. Now, Mike, let's look at what's happened so far. Money's taken in. We took in 330 for the April call spread, and my assertion was that was riskless. And the reason that it's riskless is that we're doing it in the context of owning stock.
Correct.
So if the stock goes up, well, good. I own stock, right? And again, the May call spread, we did the same thing, right? And so we end up with a total in of $6.80. Now let's talk about our expenses. Okay, we paid for the July put option, right?
We did.
We paid to hang on to our stock because it went up, right?
Yes.
And then we paid to hang on to our stock again because, well, it actually went down this time, but it still ended up slightly in the money. It was $35.21. So the total that I've spent is $777. Jackpot, right? Okay. What's my net that I've spent then?
Oh, we're at 97 cents. Is that correct?
And what do I still own? I still own the stock, right?
That's right. We still have the stock that's been moving up, and you still have the put option as well.
Ah, I still have the put option. Now, if you recall, the put option had been priced at $2.90. But now it's actually risen. Okay? Here's the ins and outs of having used the options to build a fence around my RCI position. I own the stock, right? And my conundrum is, well, I don't know if it's going to go up or down from here. If it goes up, but I sell today and it goes up, I'm going to feel like a chump.
Mm-hmm.
But if it goes down and I don't sell today, I'm going to feel like an even bigger chump, especially since I might give back all my gains and more to the market. Okay?
Mm-hmm.
Well, by building a fence around this stock, using options, one far out put option and two nearer in what we call income methods, okay, we've managed to spend 97 cents. But what we still own is the stock, all right, and a put option that, look at this, the bid on it, Mike, is $4.80.
Mm-hmm.
This is yesterday's pricing. You see the stock went down.
Right.
And after all is said and done, we've spent 97 cents for a July $40 put option that now happens to be worth $4.80 on the bid.
Mm-hmm.
Okay, so that's not bad. Not bad at all. What the deal is here, Mike? Let's just make a comparison, okay? Oh, and by the way, the break even between buying a put option and buying a stock, we narrow that by using the income methods normally when we buy stock and a put at the same time. Okay.
Mm-hmm.
And selling covered calls is one way to generate income, but there's a slew of ways to take income. And I just showed selling two bear call spreads. That's another way to do it, right?
That's right. Mm-hmm.
Here's another spread that we're going to show on Thursday. On Thursday, I'm going to show how this particular spread might pay you at the beginning. It might pay you again later, and we can eliminate all this risk on the downside. Wouldn't that be cool? Okay. Once we've reduced the gap between the break-even and the lowest possible payout,
Mm-hmm.
once we've reduced that gap to less than 0, we're bulletproof. Now I'm going to show where this particular position, if it was managed the way that I showed, is bulletproof. Okay, what was the problem? The problem was our subscriber had the stock, RCI, at a $27.50 cost basis, and the present price, well, not present today, but present then, was $38.95, and he had no guarantees about whether that stock would go up or down or sideways.
Mm-hmm.
So what did we do? We showed how it would be possible to buy a put option at $40 strike for $2.90, and to pay for that $40 put option by selling a near-term bear call spread. So it actually ended up with 40-cent credit. He got paid to buy insurance.
Mm-hmm.
That's what's possible. It's possible to build a fence around your stock with options and get paid to buy an insurance policy. Kind of cool, okay? But what's the new situation? Well, the new situation is we can cash that stock in at $40 a share, even though right now it's, hovering around $35.
Right. We can liquidate exercise the put, and close out our shares at 40. That's right.
Yeah, or what we could do, if we don't want to sell the stock, all right, and maybe we want to do this again, we can just cash in this July put for $4.80. Now, we got paid to own the put in the first place, remember? Got paid
Correct.
40 cents. And then by managing it and so forth, we ended up with those two management costs. We ended up in the red for 97 cents. We've paid 97 cents, but that put us in a place where we own the put, and it's much higher than it was.
Mm-hmm.
Okay, the cost basis is 97 cents, and it's $4.80. Okay, so oh, I blew it. I put 674. That's a 374 loss. That's what that should say. Let me change that now before I ever show that presentation again. Okay. All right. So here we are. Before, the stock was at $38.95, and our subscriber was saying, geez, I don't know. I don't know if it's going to go up or down. I'm going to feel silly if it goes up and I, sell today. And I'm going to feel sillier if it goes down and I don't sell today. Well, he didn't sell today. We're looking at the stock having a $3.74 loss, but now what we've got is a 97-cent cost basis for him to guarantee a $40 payout, or simply cash in his put for $4.80. That would more than cover the losses that he's taken, right?
That's right.
Happy day. Okay, this is bulletproofing. Now, Mike, if the stock had taken off for the moon, would he have a big problem then?
Well, with the income method number 6 in play on top of the married put, as you showed, he may have to roll that short call.
Right.
But with just the stock and the put in place, no. He wouldn't have an issue, of course, because he didn't cap the gain on that position. He could still take advantage of the further upside gains.
Well, what about this? What about having the stock and the put and the bear call spread in place?
Right. Now, the problem he might face is he may want to consider rolling that call if he still holds it, but if he decides to do nothing, well, there's still the unlimited upside gain because the long call, I think he went too far back. I'm not sure.
Yeah, I'm trying to show the graph.
There it is.
Of all the legs at once. Boom.
Okay, so there we go.
If the stock takes off for the moon, is he sorry that he did all this?
Absolutely not. He still has an unlimited upside gain. If it just gaps up to $45, $50, $55 per share, maybe a rumor of a buyout comes out and it jumps up to $58, there's still an unlimited upside gain.
Right. It beats the tar out of if he sold today. If he sold today, he would just get his $38.95. But if the stock did continue up and he did this little options play, he would still be able to participate in the upside. And by the way, we're not going to talk about it today because we don't have time. But by the way, do you see an income method number 4 opportunity if his stock goes up?
Well, of course.
Absolutely. You can guarantee a higher payout. Okay. All right. So there's that. So, folks, what I wanted to do is run another poll here. Okay. I want to ask, do you have a stock that's up from where you bought it? Do you have a similar conundrum to the one that I've shared? Okay. And I'm not asking you to share any details or anything like that, but are you in the place where you've got an optionable stock that's up from where you bought it? Okay. Or for example, if you're trading covered calls, did all of your winners get sorted out of your account because the stock goes up and the winners get called away? And of course, you might also ask, hey, Kurt, where were you? Where were you before? I had a stock there for a bit, and she went down. So it was up and then it went down. So okay, let's leave it up for another 5 seconds. Okay, that'll be the full minute of this poll. 3, 2, 1, and close. And share. Okay, Mike, more than half of our audience members that participated, more than half, have an optionable stock. All right, this only works on an optionable stock, obviously. You have an optionable stock that's up from your cost basis. Wow. Okay, 29%, all your winners got sorted out. Can I point something out to this 29%? Mike, if they had done a bear call spread and known the management techniques, if they had done a bear call spread instead of a covered call, would they, number one, still have taken some premium, and number two, still be able to enjoy the upside?
That's right. But there's another way that, well, not the winners, but the winners might have been gotten sorted out of their account another way, Kurt. Let's say they were in a covered call and the stock started to move against them and they had a stop order, which just automatically closed them out of the position and then went back up in price and became a winner, but they got stopped out before. Now, what is it about what we do that solves that problem?
Well, the fact that we've got options, it's a legal and binding contract instead of a stop order or a stop loss or a one cancels other order. We've got a legal and binding contract in place. That's the deal. Okay, you have options. It's almost like that's what that word means. All right. And for the 14% that say, where were you before the market corrected? Well, I've been here 10 years now. And we're not going anyplace. We want to continue to make the best option inventive ideas available to the public. Okay, and that's really our mission. So for the 57% that say you've got an optionable stock that's up from your cost basis, I would like to perhaps write a blog post about your situation if you want to participate. Now, if you do, I won't use your last name, and would like to only talk about the symbol, the stock symbol, and what shares that you've got. But Mike, we had Stephen, I don't know, about 2 months ago, follow something that I showed with Starbucks. I wrote to him recently. He's very, very happy. I said, "Are you happy?" He says, "Yeah, I'm really happy I picked up the insurance." We showed him where he might be able to do a very similar thing to what we just showed, and he's happy that he did. Okay, so without obligating anybody, or without, all I want to do is provide information, just free information. We're just going to let you know what is available to you. A second set of eyes, and something that you may not have considered before, because a lot of folks don't teach these types of adjustments. Okay, all right. So let me go ahead and hide that. Let's see, Mike, have we had any questions come in? We've had a lot of folks online today.
I did, just as a remark. Ken did ask. I don't want to say a personal question, but Ken was curious earlier on as to which inverse ETF I was trading, and that was actually on SH. I like to keep it simple. I don't use the ultra shorts or the 2 times or 3 times. I just use the simple ones, SH, maybe DOG, for example, or the short Qs, which name symbol just escapes me. So that was on SH. Now, Mortimer just asked a very good question, of course, because I think he's newer to the presentations. And he says, well, wait, do you recommend this strategy for new stock purchases? Why not do this on all of them? And that's what we do. I don't think Mortimer has been to one of our presentations before. So in addition to this, Mortimer, we will open a married put position, as Kurt showed. When I open a new position, as I did with SH back in April, mid-April there, I bought the stock, and I'm going to buy a put following the rules in the blueprint. And we show some of the general setup and discuss the general setup. Of course, it's also available in the archive webinars. But we set it up in a specific way. It's different than what you may read on your online broker, your free option education articles that you can find on the internet there. We like to buy puts that are at least 150 days out in time, and we're going to buy a put that's in the money. And so to start with, when we open a new position, we may only have at risk, maybe 4 to 7%, 4 to 8%, depending on a risk threshold on the position. And so what we do then is, after that position's open, as Kurt mentioned, we are bullish. So as the stock moves up, we can apply these same income methods that you saw today. And Kurt hinted about the ratio call spread income method number 5 that we're going to share on Thursday. And well, the goal is to lower the initial at risk, potentially bulletproof the position, and earn extra profits. So that's how we open every position. And I know, Kurt, you said no salesy, and I'm not trying to be salesy here, but I kind of have to, because Todd just asked, what's my next step to learn more?
Wait. Okay, I'm just going to tell about free stuff, okay? Because I want to keep my word. You know what I'm saying, Mike?
Yeah, but that is the next step, isn't it? The free stuff that's available, the free resources that are available are your next step, Todd, beyond this webinar. There's some free resources Kurt's going to share with us, and of course you can view the webinar, the archive webinars at any time, and we'll show those in a minute.
Great. Okay, Mike. I thought you were getting ready to promote a paid product or something.
I would not do that to you. I would not do that to you.
You're so cool.
I was just helping Todd, understand what his next step is.
Very good. Okay. Let me go ahead and close these polls. Mike, I did 2 polls while you were speaking, and I'm going to probably do 2 more before we let everybody go. Folks, thanks for participating. This helps me to understand more about who I'm speaking with and how I can help you. Okay. All right. So I asked the question: does your present loss management technique does it, first of all, allow you to bulletproof your stock? Does it allow you to take credits and leave your upside open? And 27% said yes, and 73% said no. We did not have the whole group answer. In fact, only 20% of the audience actually participated in this poll. So, and probably because I didn't, say, hey, there's a bullet. But point is, it's a very small percentage that are practicing this type of loss management technique. And it's also a very small percent that said they were happy with their trading last year. So I think that's not a coincidence. Here was another poll I did. I said, do you think that the market will reverse at some point, and pretty hard? 94% of those that answered, and there was more in this particular, 30% of our, 29% of our attendees participated in this poll. 94 of those said, yes, the market will correct, and 6% of those said, no, I think it'll keep going up. Either way, Mike, the technique or the combination of techniques that I showed today makes sense, doesn't it?
I agree.
Either way, but particularly if the market goes down, you're going to want to have put it in place. Okay, now I'm going to forward this to here to get a free trial to the software that I was using to show all these positions, Power Options, and Power Options is also the platform that I use to not just locate trades, but also to evaluate the before and after of various income methods. It's the most sophisticated trading platform I'm aware of, and it's who I use. I'm going to recommend that you pick up 2 free weeks there. Okay, and also you can get a consultation with Mike. That consultation is not a salesy deal. Mike is not a salesperson. Are you, Mike?
No, unfortunately, I'm not.
What Mike is all about, he's the director of education over at Power Options, and what he can do is show you how to tailor your own searches to whatever strategies that you're using in the options marketplace today. To find the best trades available. Okay, so and he'll show you how to do that for free, and they'll give you 2 weeks of it for free. There is a subscription cost. You can talk about that later with them if you decide that, man, I'd like to continue with this, but let me make this available to everyone right now. And then, having said that, I'd like to do 2 more polls and ask a few more questions, and we'll just let you go, okay? All right, so first of all, if you could bulletproof like what we showed, not necessarily the same way that we showed, but like what we showed, would you? Would you? Not everybody would, Mike, okay? But if you could bulletproof your trades like what we showed, for example, you've got a stock and it's up and you're nervous about it maybe going down and you're also nervous about it going up. Well, I showed a technique that you could use to where you could still take advantage of upside, and you could also lock in and not get hurt, even with an overnight gap, even with bad news, even with planes hitting towers, okay? You would still be able to use your put option or liquidate your put option and come out ahead. Okay, we're having real good participation on this poll, Mike. Lots of the audience has voted. Not everybody has yet. I'm going to leave it up for another 10 seconds, and then we'll do a final poll. And it sounds like you're answering questions by way of your keyboard, but if there's questions that would serve the whole audience, I'd really like to.
I didn't want to talk over you. That's all. I was just waiting.
Okay.
I was just waiting for you.
All right. Very good. Let's do this this final poll right after this one. Here's the results of this last one. We had 91% say yes, I would bulletproof my trades like what you showed. Well, I'll tell you what, if you happen to have a stock that's an optionable stock that's up from where you bought it, write me at support@radioactivetrading.com. I'd be very happy to look at your situation. I can't, first of all, I won't give you advice, and secondly, I can't guarantee that there is a play like what I showed, okay? But if there is, I'll discuss it with you, by email and let you know, okay? In our final poll, then we'll take those questions, Mike, then we'll take off. This is all I wanted to know. Did you find today's presentation helpful? And I think you can actually answer more than one of these. Like, for example, if you thought it was cool and you also think we suck. Just kidding. If you think it was cool, but you also would like to know if we've got any more bulletproof and still take income ideas, then let us know. Okay, so that pulls up for 30 seconds. We're having really good participation, more than any of the other polls. I really appreciate this, guys. Yeah, Mike, you're queuing up those questions, are you?
Yeah. I'm just getting some answers in now in case one of the questions accidentally has to leave. I want to make sure that they get at least one answer before we can do it verbally.
Okay, very good. All right, so let's give this 3 more seconds, 2 more seconds. If you haven't had your voice heard, please do. And close. All right, so some guys said, no, you guys suck. But, well, anyway, we're doing our best, aren't we, Mike?
Mm-hmm.
Very good. Okay, so 32% said that was really cool. I've never seen anything quite like it. Okay, good. And you're not likely to. You know, the hedging ideas where we're hedging hedges with hedges. All right, we used a bear call spread in this case, which is a hedged trade, to modify a married put, which itself is a hedged trade. Okay, and take out risk away from both of them. It's kind of cool. All right, 39% said that was really cool, but I have seen things like it. Okay, good enough, fair enough. And then 64%, do you have any more bulletproof and still take income ideas? Yes, we do. In fact, on Thursday, I expect to show an even cooler one. So come on back. Okay, so Mike, we've got the time for just a couple of questions, and then we'll close her up right at maybe just right after the hour. Go ahead.
Okay, these two kind of follow each other. Jerry asked, what do you do with stocks that are not optionable? And then just following that, Arnie asked, can I use this method to bulletproof a portfolio by buying options on an index such as SPY? Okay, now, here's my thoughts on this, and I'll let Kurt share your thoughts on it. To answer Jerry's question, yeah, you can, with non-optionable stocks, a good approach may be to try to hedge the losses in your portfolio by buying put options on a broad-based index or ETF, such as SPY, as Arnie mentioned. However, if I look at a broad-based portfolio and I see to myself that maybe 40% of my stocks or 50% of my stocks are in the S&P 500 list and they're not optionable, and I go and buy a put on SPY, remember it's not one-to-one insurance. And what I mean by that is that if we're going into an earnings season and the 1 or 2 stocks in your portfolio that happen to be in the S&P 500 that aren't optionable, they decline due to poor earnings, but the rest of those stocks had relatively good earnings, the SPY might actually be up while your 2 stocks are down 20 or 30%. That sort of that can happen, and that's sort of the difficulty with doing the non-optionable stocks or using a broad-based index or ETF put. It is an approach, and I say it's better than not using protection one-to-one. But the problem with just buying some of those puts on the broad-based indexes and ETFs is it's not covering your shares one-to-one.
Right. Can I dovetail onto that?
Please do. Please do.
Yeah, an individual stock is much more nimble than an index. Okay, the individual stock can be affected to the good and to the bad much more profoundly than the whole market, you know, or the whole index. I have heard of folks using indexes to build in a hedge to their money, to their mutual funds. Okay, and I think that'd be a better approach. But if it's an individual stock, I would not own an individual stock without options. For example, I'm very intrigued by Facebook, FB. I'm very intrigued by Facebook. I want to get in on Facebook, but you'll know when I'm buying it.
They will be. Oh, go ahead, Kurt.
Yeah, because they'll be trading calls and puts on it, and right now they're not.
They will be at the end of this week, end of next week, 29th, I think, 30th? Somewhere. I had an article that got sent out that said when they were going to be available, and I forgot the exact date off the top of my head. That's
when you see Frankenberg get into it, when I can give myself a guaranteed exit. When I can guarantee an exit regardless of bad news or laws changing or, you know, markets overseas crashing, you know, regardless of any of that stuff, and overnight gaps. I can get out of my shares at a pre-locked-in point. That's when you'll see me get into Facebook, for example. Okay, and other questions there, Mike?
Well, you might want to handle this one. Jerry had a follow-up question. If I own long-term options that are now in a loss position, is there any way to protect them further?
Wow.
It becomes tricky.
Well,
you can't,
see, that's taking me back in time to my friend from Dallas. I had a fellow that came over to me from another
service.
Well, service, yeah. I think it'd be a disservice to call it a service, but no, this fella came over from a company that was teaching about how to sell calls against calls. They begin with a $3,000 seminar or $3,500, I forget what it is now, for selling calls against stock.
Mm-hmm.
And then they upgrade you to a $5,000 seminar where you sell calls against calls. Well, anyway, this fellow had bought, on their recommendation, he had bought 35 call contracts, in the money call contracts on Boston Scientific, with the when the stock was trading at 14 and change. He bought the $12.50 calls. Well, by the time he spoke with me, those calls were down in value about 50%. And I told him, look, I'd never be caught in this situation in the first place, but if I had a rich uncle that left me call options, I would immediately sell them. Well, anyway, he did not do that, and he ended up with an over 90% loss. Never was able to recover his sale price by selling near-term calls against his far-term call. And so I never recommend that. But that's not the question. The question is, how can I protect it further? I wish I had advice to offer. I don't. When I began to sketch out the details of the radioactive profit machine back in 2002, it was all about hedging a stock position and only paying for one set of time premium, just a put. A lot of folks say, hey, I'd like to buy a call and a put. Does that work? Well, no. I mean, can it work? Yeah. If your stock gyrates wildly afterwards, yeah.
You need much bigger movement to profit on that sort of a setup, right?
Yeah. I would say, in the future, do this. Keep yourself protected so that you can't lose more than 6% of your investment. Okay, and then your position sizing will be kind of figured out for you. So I wish I had better news for you, and certainly it's possible that your stock may reverse. But if it were me, I'd get out. I would just get out. Okay, other questions there, Mike, or shall we wrap her up?
Yeah, we've got that covered, Kurt, and I'll just let them know, Jerry and Arnie, I have there's a presentation that Mike Phillips did, our head analyst over at Power Options Applied, or he and I did together, where we discussed the stock versus portfolio insurance, using that portfolio insurance that you talked about, Kurt, and some other techniques, and I, of course, discussed the advantages of using one-to-one insurance with the married put technique during that presentation. So I'll show you guys how to get to that. I'll send you guys a link after the presentation where you can watch that, comparing the stock or insurance, stock or portfolio insurance.
Very good. Okay, Mike, I'm sending a couple of links to our audience, and this will be it. The first is the Power Options link, powerop.com/RAT. That's for a free 2-week trial to the Power Options platform, and a consultation with Mike, who will just show you how to use it. And then secondly, blog.radioactivetrading.com. That'll take you to the most recent blog posts, including my update to the March 26th post that was the basis of today's presentation. And then finally, if you want to write me at support@radioactivetrading.com with your, whoops, I gotta spell that correctly, with your particular stock that's up from where you bought it. 57% of our audience said, man, I've got a stock that's up from where I bought it. So, and I'd like to know maybe if it's possible to do one of these cool setups. Well, if you feel comfortable with it, go ahead and write me your details as far as what your cost basis was, what the present price is, and that's really all I need. How many shares is also good for me to know. Then I'd be very pleased to send you some ideas. Okay. All right. Well, I guess that's it there, Mike. There's our Dog and Pony Show. We've got her figured out. And folks, if you have any questions that pertain to the presentation that you think of afterwards, please send us your email again at support@radioactivetrade.com.
That's right, and we'll see you guys all on Thursday, right, Kurt?
That's the one. Very good. All right, gang. Thanks, Mike, for coming, and thank you, everybody, for your attendance, and we'll see you out there. Happy trading, and bye for now.
All right.